So it's live on YouTube now, huh?
Yes, we are live.
So we will just wait for max 1 minute or so, and then we'll start the proceedings.
Okay.
You can keep in the gallery mode, I think, for the moment. Shall we start, Safiq? What do you think?
Yeah, we can start.
Yeah, let's start. Yeah, it's okay. Good evening, everyone. I hope you all are keeping safe and doing well. We rolled out our vaccination program along with the sponsors, Burjeel Hospital, but unfortunately, the authorities have put it down, and probably for the first dose of vaccination, it is not available for everyone. But we come to know that soon, probably by end of March or beginning of April, because that is the next appointment date they are giving for the first vaccination. The vaccination should start again for everyone. And those 200 members and their families were able to take advantage of this arrangement and got vaccinated from Abu Dhabi chapter. Uh, those who were not able to take, I earnestly request that as soon as it opens up, please do take an appointment or walk in and get it done. Probably this is the only way to be a little safe. An update from ICI Delhi, our head office, that there has been a change in the guards, and our president, CA Atul Kumar Gupta, stepped down. And he did a remarkable, journey. His year was amazingly great. And he handed over his presidentship to the vice president, CA Neha Jambusariaji, and the new vice president is CA Mitra. We congratulate the new leadership, and we look forward working with them. We continue to embark our journey on e-learning, and now I think e-learning has become a usual learning, because this is the only mode where we are able to pass on information, share knowledge, and we think at some point it does get a bit stressful to keep doing this e-learning and online programs. And this is where we try to mix and match the sessions so as to make it a little bit interesting for our members. And I hope that members appreciate that. Today we have Joanne Clark from Vincent Mansons, who will be providing insights on VAT. And the other session is on Global Investment Opportunities 2021 by Yogesh Khairranjani. He's from Century Financials. The chapter is trying to engage with all stakeholders, members, sponsors, well-wishers by doing webinars and social events. We have a couple of social events lined up coming soon. The MC has planned a fun and win game bingo for our members on 27th evening, with prizes to be won worth around 4,000 dirhams. I request all the members to join and enjoy this fun family fun event. Please pay your membership fee and confirm your participation. The much awaited ICI AUH Cricket League tournament is being planned to scheduled on 26th and 27th, where about 75 chartered accountants will be showing their cricketing skills. Our 36th AGM is scheduled on 4th of March, so do please attend. I welcome you all to this virtual CPE event on a very apt topic, VAT update and global investment opportunities 2021. I request everyone again to be safe and please get vaccinated as soon as it is available again. Now I request our committee member, Mohammed Shafiq, to take over the proceedings, please. Thank you.
Thank you, Neeraj. Good evening, ladies and gentlemen. It's my pleasure to introduce the first speaker of the evening, Ms. John Clark. John Clark is a tax director, VAT at Pinson Massons. John is a qualified chartered accountant and a chartered tax advisor. She is an international VAT advisor with 13 plus years of experience advising clients and corporate groups of all sizes across a range of industry sectors on VAT compliance, automation, tax structuring, and technical matters. She has ample experience in dealing with analysis of tax law, tax judgments of the courts, and collaborating with tax authorities across a range of jurisdictions. In the Gulf states for the past 4.5 years, she has supported everything from SMEs to large corporate multinational groups with VAT implementation in the Gulf, together with post-implementation compliance, advisory, and tax authority support. Ladies and gentlemen, let's welcome John Clark. Over to you, John.
Thank you so much, Shafiq, and good evening, everyone. And thank you for having me on this session today. I'm very, very pleased to be here and to cover an update on the UAE VAT regime. Let me just share my slides with you. Hopefully everybody can see them. Today's session, which is the first of two, as the introduction said, and thank you so much for that lovely introduction, is an update on the UAE VAT regime. And we say an update as I know that the ICAI Abu Dhabi chapter has kindly arranged previous sessions for you on the UAE VAT regime. So hopefully everybody on today's session is familiar enough with the regime. The aim of the next sort of 35-40 minutes is to give you some insights on a number of key areas under the UAE VAT regime. The first area, there hasn't been any legislative or regulatory changes, but because of the market that we are all experiencing at the moment, we see a lot of restructuring, new entries coming into the market, exits out of the market because of the financial pressures. And so we're going to concentrate for 10 or 15 minutes around corporate groups, holding companies, and what you need to think about when you're engaging in sort of M&A transactions in the region from a VAT perspective. Then we're going to look at some of the other recent updates that we've seen from the Federal Tax Authority in the region, one of them being some clarifications around sole establishments. So we'll cover that. We're also going to look at voluntary disclosure penalties. And really, we've decided to pick out this topic because it has been quite a controversial judgment at the Supreme Court in Abu Dhabi, the Federal Supreme Court. And it's important that businesses in the region understand what that judgment means for them. Lastly, we'll touch on very quickly the VAT form 301 restrictions. This is a form used for importing goods into the UAE for VAT purposes, and there has been some changes around how and when you can use that. So we're going to cover that briefly, and then obviously we will be very happy to take any Q&A you have on any of these topics. So to delve right in, I guess I probably don't need to tell anybody on today's session what we're seeing happening around us, and the second session today we'll touch on that definitely a lot more. But obviously there's been a lot of activity in the region over the last year or so, reacting to, I guess, the financial pressures around supply, demand, and pricing in the oil and gas sector, but also all of the pressures that we've seen as a result of the COVID-19 crisis. So we've seen businesses, we've seen a lot of buyouts of smaller businesses by large international corporations. We've seen particular regions starting to invest a lot more into the UAE. And we've also seen groups just restructuring themselves generally in the region. We've also seen a lot of new large-scale projects, which are obviously driven by the government in the region in terms of investing in particular industry sectors, encouraging foreign direct investment, tourism, etc. And a lot of these new large-scale projects tend to have foreign companies coming in and investing, SPVs being set up, etc. So a lot happening from a corporate structuring perspective as a result of the financial pressures and also the financial opportunities that we see in the region. What does that mean from a VAT perspective, and what do businesses need to think about? And I'm going to walk you through each of these, I guess, one by one. The first thing really is for businesses to be aware of holding structures from a VAT perspective and what they mean. And I'll talk you through what I mean by that. If we look at VAT regimes all around the globe, including in India, VAT tends to be a little bit of an issue when it comes to holding companies. And the reason for that is the holding structure at the top of many corporate groups can look very different. You can have passive holding companies that just genuinely hold shares in the subsidiaries below them and have no active interaction with those subsidiaries or trade in their own right. You can have very active holding companies that do active management of their subsidiaries, buy in centralized costs of the group and recharge them down, or have their own independent trade activity. And then you can have a mixture of both. So you have some groups that their holding entity or holding entities are active in some regards and not active in others. And why do we care about that from a VAT perspective? We care because VAT as a tax flows through a supply chain when everybody in that supply chain is charging VAT. So if you have an entity in a corporate group, like a holding entity, that might be passively doing something like the holding of shares in itself is not a taxable activity. It's not something liable to VAT. And therefore, any costs associated with that on which VAT is charged would not be recoverable. So really what we're saying is VAT coming into passive holding companies can be a real cost for businesses. It'll hit their P&L, it's not neutral, they can't recover on their VAT return. On the flip side, if you do have an active holding company, you want to make sure that rebilling down to subsidiaries, management activities have the correct contracting behind them, invoicing behind them, etc., to ensure that you do get recovery on your costs. And I think one bit around corporate groups in the region and these holding structures to be wary of is even where a holding company is active, so it does have shared costs or management activities and recharges down to its subsidiary entities within the group, it'll always still have a passive element. So one job of that company is still to hold the shares in the subsidiaries. And that's a very ambiguous point. It's one that has been debated around the globe for many years in the VAT regime. It's gone to many courts around the globe in terms of what the whole recovery of a holding company should be. And in the UAE to date, we have no guidance from the FTA. Saudi Arabia, so Gazat and Bahrain tax authorities have published some wording around what you should do in holding group structures, but the UAE at the minute has not published anything. So it's just to, I guess, be aware as we see all of these change, the challenges that are already there in a holding group structure, and that businesses need to think about before we see any large changes like mergers or acquisitions or merging companies together. The other thing to be aware of around corporate groups as well is the intercompany transactions within a corporate group. As a region that historically did not have a significant federal corporate tax regime or capital gains regime, intercompany transactions in the UAE have always happened pretty freely. VAT makes that slightly more difficult. Interactions, supplies of goods or services, and when I say services, of course, that could be something like one corporate group member letting another corporate group member use their employees, use a piece of real estate. So it's not always a service that's really clear and there may be no consideration for it. They are taxable activities and they are liable to VAT. So in the absence of a VAT grouping, any transactions between corporate group members may have a charge to VAT. And I guess this is an area that even though VAT has been here for 3 years, even though businesses are well familiar with the VAT regime, time and time again, we're seeing inter-group transactions without a VAT group in place which are creating risk for businesses in the region. And we've seen it on audits with the tax authorities where they would impose VAT on these transactions, and it would be an outstanding liability for the group. Another aspect to these intercompany transactions is that often they happen with no consideration. So there could be a netting in the books between the two entities, or barter type transactions where goods and services are being provided in return for each other. Any transaction, again, without a consideration for VAT purposes, we have these provisions called deeming provisions, which will apply VAT even where there's no consideration, and specifically between connected companies. And from a connected company perspective, related persons for VAT purposes, often VAT may need to be calculated on the market value, which can be very important because a lot of corporate group transactions may take place at a nominal value. So that's one thing to be wary of. Of course, VAT grouping is a good optimization tool in the region for any groups that are not using it, or in the past assessed that it didn't make sense to use it. Now, I guess post-COVID, if I can use that term, they may want to reevaluate whether VAT grouping is a smart and optimal tool for them. The pros of VAT grouping, of course, is that you have one VAT return for every single entity. Intergroup transactions do not attract a charge to VAT. You don't need to raise VAT invoices, and it can be administratively less burdensome. The downside, of course, is that there is joint several liability between every entity in the VAT group for any VAT amounts due and penalties due. So that is the risk of VAT grouping. If we take a particular example as to how that risk might actually materialize, if there was an entity within the corporate group that was only 50 or 60% held by the corporate group with an external investor, maybe a joint venture entity, then VAT grouping them may be challenging, or you may need to try and consider whether it makes sense to VAT group them. And then lastly, I guess, around corporate groups and a lot of these larger transactions that we're seeing in the region, VAT deduction is always an important point. I talked about the passive activities of a holding company and the fact that holding of shares is not VATable, and therefore does not give you a recovery of VAT on associated costs. That's something you really need to watch. And obviously, in the context of VAT grouping, if you group a lot of corporate entities with a lot of different types of VATable activities, some may be exempt, some may be liable at 5, some may be 0 rated. So it's important to look at your apportionment. For those not familiar, apportionment is the methodology that you agree with the tax authorities on how you're going to recover VAT on your purchases when you have a mixture of both VATable and exempt activities. And there is special apportionment methods you can obtain off the tax authority for this, which we are actually going to cover in a couple of slides because there has been an update on those special mechanisms. So just things that I guess, even without any change in law, businesses should be thinking of at the minute, especially if they're going through a time of change and restructuring. Of course, I wouldn't be right to not put penalties on the slide. You know, in getting any of these VAT treatments, VAT deductibility, grouping, apportionment wrong, obviously there is a huge risk of penalties in the region. As I'm sure many of you know, the penalty regime for VAT is quite severe. I would say perhaps the most severe I've seen around the globe. So it's really important to try and get these things right up front rather than cleaning them up and then having the risk of penalties. If we look at restructuring and concentrate a little bit more on the mechanisms through which some of this restructuring can be done, and we just zone in, I guess, on two methods, so share sale versus a business transfer, and think about a little bit more what that means from a VAT perspective. Under the UAE VAT law, the issue or transfer of shares is an exempt activity. Exempt activities do not allow you to recover VAT on your purchases or associated costs. So if you're undertaking a restructuring through a share sale, for the seller, they need to be conscious that any VAT on associated costs, things like lawyers' fees, etc., would not be recoverable. So you need to be looking at the gross cost of those when you're budgeting for that share sale. On the purchaser side, I would say it's not as straightforward. And again, the UAE tax authorities do not have that much guidance notes on this. But if we look to the guidance we've seen in Saudi Arabia and what we've seen across the globe on this, as a purchaser, you need to actually look at why you're purchasing the shares in an entity. If you're purchasing the shares in an entity because you trade in shares and you're going to buy and sell, and that's an activity you do, then again, it's unlikely you would get VAT recovery on associated costs because trading in shares is exempt. On the flip side, if you buy the shares in another company to make that company part of your trading group, whatever your trade activity is within your group, if it's a longer term investment and your group generally has VATable activities, then there is a good chance that you would get recovery on costs associated with that share transaction. So you need to look at it from the different angles to see whether you'd have recovery on your costs. Other things that are important around a share sale is things like the capital asset regime, which monitors the deductibility of VAT over the life of a capital asset, and VAT grouping. We spoke about VAT grouping already. If you're buying the shares in an entity that's already in a VAT group, or you want to add it to your current VAT group, then there may be some things you need to think about there in terms of the impact of adding that entity to a VAT group. So these are sort of the peripheral things that need to be thought about as a result of share sales. If we transition over then to a business transfer, which in essence is all of the assets or part of the assets, whether they're tangible or intangible, transferring from one entity into either a new SPV or an already trading entity. There's a few things we need to think about there. Naturally, the sale of tangible or intangible assets would just follow standard VAT rules in the region. So you look at the type of asset, is it VATable at 5? Is it 0 rated? Is it exempt? And under the purchase price, you would split the purchase price between all of the different assets and apply the correct VAT treatment. Obviously, that's quite burdensome, and like most VAT regimes around the globe, the UAE has a transfer of business VAT relief. And in essence, what this relief does is it states that if you transfer an entire business or a part of a business that can be operated on an independent basis by itself, then that transaction would be viewed as outside the scope of the UAE VAT regime. There's a few important aspects to that. You cannot just transfer a stock of goods. You have to transfer a business that could be operated independently if it had to be. So depending on the type of business, you might need to transfer, vendor customer contracts, employees, IP rights, etc. as well. You need to assess that based on the type of business. As another example, a type of business that would qualify would be real estate that already have tenants in situ. That would be viewed as a real estate business. So if you transferred the property with the tenants in situ, you would qualify for the transfer of business relief. Transfer of business relief is always seen as a benefit because no VAT needs to be accounted for. Therefore, you don't have the seller charging VAT and the purchaser having to try and recover that VAT from the tax authorities. But it does have some difficulties with it, which is you need to assess whether transfer of business relief applies or not. That in itself can be challenging sometimes depending on the fact pattern. And then if it does, the transaction becomes outside the scope of VAT. And as we said already, in order to recover VAT on associated purchases, you need to be making a taxable supply. So if your business transfer is no longer viewed as a taxable supply because it's outside the scope, then you need to look at what would my recovery be on associated costs. And we all know how large the associated legal fees, etc., can be with transferring a significant part of a business. And really, again, that comes down to the type of business that you're transferring. So if I'm acquiring a new business and I'm transferring it in to my current business, and my current business and the new business are something that would normally be liable to VAT, so a retail, manufacturer, whatever it might be, then there's a good chance I would get recovery of VAT on associated costs. On the flip side, if the business being transferred was an exempt business and it's coming in and I will continue to use it as an exempt business, then it's unlikely I would get the recovery of that costs. So it's just to show you, I guess, the difference. Share sale generally falls within exemption and therefore no recovery of VAT. Business transfer, you would normally have to apply VAT on all of the transfer of assets, tangible and intangible. Unless you get the transfer of business relief, which if you do, then you need to be careful on your recovery of that, because if the transaction is outside the scope, it's not normally giving you a recovery of your VAT. And then I guess there's a lot of other complex structures that can be used to transfer businesses. You know, we see share swaps, we see barter transactions, we've seen other mechanisms where there's a transfer of a business today with only part consideration paid, and then the consideration may be paid in milestone payments in the future, or maybe dependent on the actual trade revenues of that business over a certain period of time. So all of those things create more VAT complexity for the business. And you need to think about things like, what is the actual transaction that's happening? When will the consideration actually be paid? What is the correct VAT treatment? When do I need to raise a tax invoice? And I would definitely say, from my own international experience and locally in the region, when these large business transfers are happening, whether it's shares or via a business transfer, you know, raising a VAT invoice tends to be the last thing the businesses are thinking of. And because the values are so large, it can be something that really creates problems further down the road for the business because of not dealing with it. So of course, the advice, as always, is to try and deal with these things upfront. Make sure that the legal team is dealing with it upfront in terms of, you know, the contract for the sale, etc., and that VAT is thought of. Okay, we're going to transition hopefully quite smoothly onto our next section, which is other recent FTA guidance that has come out. So that first section really wasn't, there's no change in regulation, there's no change in law, there's no new FTA guidance, but it's a set of rules around holding companies, corporate groups, M&A, that obviously we're seeing a lot more of. So we thought it would be relevant to just recover those principles with you. The first in the new, I guess, updates in the region is around sole establishments. It was an update that was released by the FTA via public clarification P021, if you do want to go read it. I guess firstly, let's look at what a sole establishment is from a regulatory perspective in the UAE. It is a means by which a person or persons can do business without it having a legal personality of its own. So I think the most important thing is that this is really a person in business in their own capacity, but from a licensing and regulatory perspective, they're obliged to register as a sole establishment. And therefore, from a tax perspective, from a VAT perspective, they're not seen as, each sole establishment is not seen as a separate VATable person. The individual behind the sole establishment is the taxable person for VAT purposes. So public clarification P021 was really just trying to re-emphasize that, or share the tax authority's view that sole establishments will not be seen as independent taxable persons. The private individual behind them is the person who needs to register for tax purposes, should only have one VAT number, no matter how many sole establishments they have. So if they had a mainland sole establishment trade license, and then let's say a free zone sole establishment trade license, they would not have two separate VAT numbers. Of course, like we've seen with branches back in 2018, when VAT was first introduced, there has been a lot of confusion of this down through the years. We've seen many corporates that had VAT numbers for every single individual branch, which is not correct, because it's only one taxable person. And so what the clarification has said is that when you look back to what you have done as a private individual with sole establishments since VAT has come in, if you do have multiple VAT registrations, it's okay, and the FTA are not going to ask you to cancel them unless they write to you. But if you assess each sole establishment as a separate trade, and each sole establishment, when looked at separately, did not exceed the VAT registration thresholds, and therefore you did not register, then you have made an error, and you do need to go back and correct that. And really, all of the turnover from all of the sole establishments of that private individual need to be combined and look at the VAT registration threshold on that basis. So this clarification, definitely, if there was individuals trading in the region with sole establishments that were looking at their sole establishments independently, this update definitely would have created some issues in terms of having to clean up what they've done today and sort of do a backdated registration and possibly a voluntary disclosure. So that was an important update that came through. Just to cover two or three more that we've seen in the last few months. So we talked about the entitlement to recover VAT on purchases, and that it's driven by what those purchases are related to. So if the purchases are related to taxable activities on which the supplier charges that at 5 or 0, you can get recovery. And we talked about the fact that if there's a mixture of both vatable and exempt activities, you would need to do apportionment. So the FTA released a guide on special methods of apportionment quite a while ago. I'm pretty sure it was 2018 or early 2019. It's VAT Guide IT1. And this was updated in October 2020 with 2 updates. Firstly, they made it obligatory that you do a 12-month look back in calculations when you apply for these special methods. I think many were doing it anyway, but to make it clear, they made it obligatory that you have to give them 12 months of trade activities, what you're doing that's vatable, what you're doing that is exempt, and why you think you should get this special method of apportionment when you're applying for that special method. And the other thing, which I think it was very, very helpful for taxpayers, was the common error list that they published. So there was a lot of back and forth between businesses and the tax authority when these apportionment special methods were being applied for, going back and forth, asking questions and asking for documentation. So this common errors list definitely helps businesses that when they're submitting a request for a special method to sort of get everything submitted all in one go and make sure that they're ticking the right boxes so that they can get that over the line much quicker. From an owners association perspective, we had another public clarification back in November, P022. And if we just take a step back, maybe before we delve into this one, when the real estate guide was released by the federal tax authorities in 2018, it's had a number of updates since, but once it was released, the FTA made it very clear that they viewed owners associations as bodies that would need to register independently for VAT purposes because they were providing services to their members and would need to register and charge VAT on those services. I was significantly involved with a lot of real estate players in the region at that point in time, and I remember us registering hundreds of owners associations. So this was a real issue for the region. What's happened, what's progressed since then is, aside from VAT, the law in the region has changed, and we've seen a federal law issued which took effect on the 3rd of November 2019, which shifted all of those obligations off the owners associations and transferred them onto the management companies. And any big players in the region that have management entities and owners associations will be well aware with that law. But actually, when that happened, there definitely was some inconsistency as to what was happening in the region with the VAT registrations. And so this public clarification was really to restate that owners associations should have deregistered when that law came out back in November 2019, that there's a 10,000 dirham penalty for not deregistering on time. So any OAs that are still registered will feel the burden of that penalty, and that the management company should have registered and picked up that compliance activity of charging VAT to its members, issuing VAT invoices, and filing periodic VAT returns. So this clarification isn't really new news, but I guess it's a very public reminder from the tax authority to anybody who still has owners associations registered and management entities which have not yet registered, that they need to do so. And this is definitely in the context of larger developers that retain parts of the land or have the common areas within buildings, but it can also be much smaller developments as well. So any entity, I guess, which still has common ownership and runs a management entity needs to think about this update. The last sort of other FTA updates we'll cover is around the temporary zero rating of PPE. So many VAT regimes across the globe introduced either reduced VAT rates, exemptions, zero ratings, etc. for PPE equipment at some point during the year last year. The UAE followed suit, while the public clarification, which was 023, was issued in December last year. It actually took effect from 1 September last year until the 28th of February, so just in a couple of days' time. And it just increased what could avail of zero rating to include very, very specific PPE equipment. It was on both local purchase and sale and also on imports, which obviously was a very welcomed zero rating. The question now is, this expires on the 28th of February. So will this be extended, given where we are on our COVID journey? Is there a need for it to be extended? I guess that's something sort of over the next week that we'll be looking to see if there are any updates on in the region. So that's just a flavour of some of the changes we've seen in the UAE. I guess from that, one message I would say is that the GCC regime as a whole, and I know the ICI Abu Dhabi Charter are hoping to have a more general GCC VAT session over the coming weeks, but the regime is constantly changing. So regardless of what industry sector you're in, regardless of what kind of corporate structure you have or what is on your business's agenda for the coming year or two, it's constantly changing. It's quite fast paced. And so keeping up to date with these small adjustments and changes is really important, just to try and avoid triggering any unnecessary penalties in the region. We'll move on now to voluntary disclosure penalties. So I guess this topic we chose because of the most recent Supreme Court decision in this area. But what I'm just going to do before we actually delve into the decision that was released is maybe walk through the voluntary disclosure process, walk through the penalties process in the region, and then look at how the court concluded on this matter. So we've set out there the different parts of law and FTA guidance that covers voluntary disclosures in the UAE. For anyone who's not familiar, voluntary disclosure is an obligatory submission that a business has to provide to the federal tax authorities if they identify that they've made an error in a previous VAT return in terms of VAT payable understated, or if they claimed a VAT refund and find out that they claimed too much VAT refund. So in other words, where the tax authority was down VAT. And they're obliged to submit this VD where the VAT error is 10,000 dirham or more. So they either underpaid the tax authority 10,000 dirham or more, or they overclaimed a VAT refund of 10,000 dirham or more. The timeline is that the VD should be submitted within 20 business days of you becoming aware of the error. And there's a formal voluntary disclosure form that needs to be filed on the tax authority's e-services platform, together with a voluntary disclosure letter detailing all the facts of the error and also evidence showing the values involved, etc. So some may be familiar with this process. Hopefully many have not had to do it before, but this is what the voluntary disclosure process is in the region. Nothing unusual, very similar to other VAT and GST regimes across the globe. Automatically, because a voluntary disclosure is in essence saying to the tax authority, we have made an error in our VAT compliance in the region, the penalty regime will kick in. These are the pieces of law in the UAE that cover the penalty regime applicable to VAT. They're not specific just to VAT. You'll see some of it's covered in the tax procedures law and the separate administrative penalties law. So they do apply to other taxes as well, but these are the sections of law that cover penalties. In the table, I've just extracted the most relevant penalties for the Supreme Court case that we're going to look at around voluntary disclosures. And you'll see that there's really three categories. There's one fixed category and two percentage-based categories. So the fixed category, it's about filing an incorrect VAT return. Obviously, if you identify you have a historical error, then that means whatever VAT return that error relates to was an incorrectly filed VAT return. If it relates to one VAT return, then the penalty is 3,000 dirham. If you have multiple VAT returns in which you've made an error, then the second and subsequent VAT returns, the penalty will be 5,000 dirham just for making an error on the return. Then when we look at the percentage-based penalties, the first one is about tax benefit. This is the way it's described in the administrative penalties law. So it talks about the fact that you should have paid that cash to the tax authority, and because you didn't, you had the benefit of that tax from a cash flow perspective in your business over a certain period of time. And this penalty is dependent, the value of it is dependent on whether or not the business has made a voluntary disclosure and when that voluntary disclosure was made. So if you made a voluntary disclosure before you ever got notified of an audit or anything from the tax authority, then the tax benefit penalty would be 5%. If you make a voluntary disclosure after you've been notified of an audit, but before the audit starts, then it's 30% penalty. And lastly, if you make a voluntary disclosure during an audit process, so the audit has already begun, then the penalty is 50%. So that's how the tax benefit penalty works. The last penalty then is also percentage based, and it's called the late payment of tax liability. So this is about the tax authority now not having the use of the money and you being penalized for that. And it's calculated as 2% for the first 7 days that the payment's outstanding to the tax authority, 4% for the remainder of that first month, and then 1% thereafter with a cap at 300%. I think already we can all see that it's a lot of percentages and a lot of penalties. And if we just compare, I guess, to other regions that we all might be familiar with, probably back in India as well, from a tax perspective, normally what we're used to seeing is a penalty. So a penalty normally fixed, but obviously not in every jurisdiction, but normally a fixed penalty, and then interest. And it's normally either simple or consolidated interest. So we're used to a percentage-based being penalized on a percentage base based on the amount of VAT or tax that's outstanding. But here we have a fixed charge and 2 percentage-based charges. And that's quite significant, I guess, in terms of penalties, especially where you are making a voluntary disclosure. So if we look at, I guess, this Supreme Court case that we've seen in the region, and it was a voluntary disclosure case, and it was where VAT had been underpaid to the tax authority. 2 conclusions came out of that court judgment. The first one is that the penalty should be calculated from the percentage-based penalty should be calculated from the date the error occurred and not the date on which the error was identified. So obviously a lot of taxpayers had been discussing with the FTA and also had made appeals on some of the decisions made by the FTA to the Tax Dispute Resolution Committee, stating that they thought the percentage should only start calculating from the date that the error was identified. The Supreme Court overruled this and said, no, the percentage base should start from the day the error was made, which in essence is the filing date for the VAT return that the VAT should have been disclosed in. I'd say this outcome is not all that surprising. Obviously, with such a penal penalty regime going back so far is going to be significant. But if we look at international regimes around the globe, normally your interest, and it's usually interest we see, would start clocking from the VAT return that you should have filed it in and the due date for that VAT return. So I would say that outcome is not surprising. While a negative one, it's in line with international best practice. Whereas the second one was around that last penalty that we have highlighted in yellow there, so the late payment of tax liability. And the outcome was that that penalty is due even when a voluntary disclosure has been submitted and cannot be mitigated or reduced in any way as a result of a voluntary disclosure being submitted. And that goes against what taxpayers had already successfully gotten over the line with the FTA, with the Tax Dispute Resolution Committee, and also at the earlier tiers in the court system. And the way that that had been managed is actually that once a voluntary disclosure had been submitted, what was happening is that the first 2 penalties were being applied only, or a level of mitigation was being applied to the last penalty because a voluntary disclosure had been submitted. And so the outcome of this Supreme Court judgment is quite harsh, that you're being taxed for both the use of the money and the tax authority not getting use of the money. It's double percentage, and it's quite heavy-handed, I guess, on taxpayers in the region. What's the impact of the Supreme Court judgment? Because it hit news outlets across the region. Many taxpayers and professionals were talking about it. I think it has created an increased reluctance by businesses to submit voluntary disclosures, because I guess if you thought you could mitigate a lot more penalties by submitting the voluntary disclosure and now you're not able to do that, you naturally would have the question, should we voluntarily tell the tax authority about an error? Is that really going to benefit us? I think a lot of businesses will also try and depend on the 5-year statute of limitations. We're 3 years in to VAT in the UAE, a little bit more than 3 years now at this point. And so if there was a once-off error made 3 years ago, and we're not, we're only 2 years away from the statute of limitations, businesses might be depending on that as well. And I think it also increased concentration by businesses on making sure that the errors don't happen in the first place. So going back and looking at your internal tax governance, your processes and controls, automation, the review process for the tax return, etc. Because now there's even more need to make sure that you're getting it right up front. I think one thing that I would comment on the case is that a voluntary disclosure is an obligatory obligation. So it's not really, should I submit a voluntary disclosure? The law says that you are obliged to submit a voluntary disclosure if you identify an error. And I think that's one thing businesses need to be very cautious of, because if there's an internal audit trail that you have identified an error and not disclosed it, I think you then shift yourself into evading tax, which is obviously not a location that businesses in the region would want to be in terms of tax evasion and criminal offences, etc. So I think there's a real fine line here for businesses on how they identify, how quickly businesses identify error and how quickly they disclose them to try and get these penalties down, because percentage-based also is somewhat time-based. You see the percentages change after a certain period of time. So the quicker errors are identified, the better. I'm just going to finish up, and it's definitely a light touch topic, so it's not going to take too much time, on one other update that we've seen in the region, and it's around the VAT Form 301 for imports. So again, I guess maybe just to give this update some context, I'd say as a general rule, import VAT incurred on the import of goods into the UAE by VAT registered businesses in the UAE is intended to be accounted for as an automatic self-accounting on your VAT return. So what I mean by that is it's intended by the FTA and the tax regime in the region that if you are a VAT registered business in the UAE and you import goods, that you wouldn't pay VAT at the point of import, and that it would automatically hit your VAT return when the VAT return is created online. That's the intention, that 90% of businesses would be in that space. Unfortunately, for that to happen, the business needs to be VAT registered, also needs to have a customs registration number, and needs to have linked the VAT number to the customs number for that sort of automatic completion of import VAT to file onto your VAT return. And many businesses in the region are not in that space. And so the VAT Form 301 has been used to record, to declare and pay import VAT on goods coming into the UAE where businesses didn't have a customs registration number or hadn't linked that number to their TRN. The update is that Form 301 is now being deactivated as of yesterday officially, and therefore it's not the standard approach to account for VAT on imports anymore, with the FTA saying that the options available to businesses is to obtain their customs registration number now and link it to their TRN, and that automatic reverse charge mechanism where it hits your VAT return automatically will happen. If a business already has a CRN, then just to do the process of linking it with their tax number, or to use third-party customs clearing agents to clear the goods for VAT purposes, and then the clearing agent issues a special document to you in order to allow you to recover the VAT. So this is, I guess, a change in procedures that businesses in the region need to get to grips with. The VAT Form 301, I believe, will continue to be available for very specific circumstances. So if you are a clearing agent, you would still be able to use it, and other limited pre-approved circumstances in terms of designated bodies and some particular companies within designated zones, etc. But generally speaking, I guess it's going to be more difficult to use Form 301 going forward. And so if it's something that was being used frequently by a business, it'd be important now to try and update that process and just try and get this customer registration number linked with the TRN number. Okay, that's all for me. Hopefully some of that has been helpful for some of the members that we have on the session today. It's a couple of different topics, not all linked to each other, but hopefully, given the current times we're in and what businesses in the region are doing, topical and adding value for the members. So Shafiq, I don't know if we have a couple of Q&A that we want to cover.
Yeah, John, thank you. It was a wonderful session. Thank you for sharing insights and informations. I've received a lot of questions, in fact. So I'll shoot the questions. The first question is from John George. If the shares are sold in secondary market or outside the stock market, which value, the capital gain or full sales value, should be reported in the return as exempted category?
Sure. Good question. So I guess because we don't have a capital gains regime in the UAE and we don't have a corporate income tax regime in the UAE either, VAT is just going to fall back to your share sale value, so your sale price. Will that change as the tax regime, the broader tax regime in the region develops, which I expect? I don't want to ever say it because I feel like I bring bad luck to the region when I say corporate tax will come one day. It might change, but at the minute you'd be looking at the actual sales price rather than the gain on the sale.
Yeah, interesting. Thank you. We have another interesting question from Ashwani Kumar. It's related to VAT group and the amendment in terms of sole establishment. So can the owner of sole establishment now become the member of VAT group, which has LLC and free zone entities owned by family members?
I don't think it, and I will take someone who corrects me, I don't think there should have ever been an issue with a sole establishment being in a VAT group. Technically, the law doesn't ban it. The issue with it is meeting the criteria. So the criteria for a VAT group is that all of the members of the VAT group have some sort of link economically, financially, that the trades are similar, etc. So the law doesn't particularly ban the owner of sole establishment from being in a VAT group, but it may be difficult to prove those connections unless that sole establishment also maybe has shares in some of the other companies or it's a similar trade. You still have to prove that, like an actual corporate group that are normally, predominantly 50 or 51% held at the top, that there is a close link between that sole establishment and the other members in the VAT group that you want to group it with. So I think it just comes back to your basic VAT grouping conditions and being able to tick the right boxes. And I think it could be difficult in some instances, but that's not to say that in others you couldn't fulfill the criteria.
Yeah, thank you. We have another very interesting question from John George. It's regarding the sole establishment, the theme
Sure.
we have already talked about. So the question is, if one of the sole establishment currently filing VAT return plan to convert into single person company LLC, should that establishment need to combine with other sole establishment of the owner? What is the procedure to change from establishment to a single person company LLC? And one more thing,
Sure.
Recently there are a lot of issues in terms of VAT registration for sole establishment. As you know, right, in this market, the business are owned by maybe UAE national, but it is just for the legal requirement, but it's actually owned by any other expats. So in that case, they're also facing a lot of difficulties. So what is a way out for this?
Yeah, unfortunately, even though practically a sole establishment and an LLC owned by one individual, like practically are the same thing, right? One, you get legal liability protection. The other one, you're not getting your legal liability protection. But unfortunately, from a VAT perspective, they look at taxable persons separately. And under a sole establishment, the private individual behind the sole establishment is the taxable person. So Joe Bloggs is your taxable person. Whereas when you set up a LLC owned by a sole person, the LLC is the taxable person. And because they're not the same thing, you can't actually just transfer the VAT number across. You would have to do a deregistration and a re-registration. And therefore, to answer the first question by John, you would look at the date of cutoff. You'd have to look at the date of cutoff. So if you're looking at the sole establishment in the context of all of your other sole establishments, you'd have to look at the date of cutoff that trade goes in under your LLC, and that's how you would assess it. I hope that answers the question. Shafiq, I don't know if there was a second part to your question there. I didn't catch it because it was a bit of a freeze in the Zoom.
Yeah, so my question was, usually here, the sole establishment, usually it's started or incorporated by expats, though it isn't owned by UAE local, that structure. So they are currently facing difficulties. So is there any way out or things to be taken care now, especially in structuring what kind of form they wanted to start the business here?
Sure. I guess that's probably less a VAT question and more a corporate structuring legal entity question. But look, we do a lot of work with the AGGM, and we do a lot of work with expats that are trading in the region. And I think if ever there was a point to be made for trading in the UAE, is that the way in which you can do it is constantly changing. I mean, we see it with the foreign direct investment law that you can now have, more than 49% ownership on mainland, etc. The way you can do it is constantly changing, and so the vehicle through which these foreign owners or foreign investors are trading in the region, I would say, needs to be constantly reviewed as to whether it's the right structure or not. From a VAT perspective, yeah, but also in terms of the legal setup of how they're doing it. And, as John has said there in his question, VAT grouping, these kind of things are not always used by foreign nationals investing in the region, because they just might not be as aware that they can group, that they're able to group, that they could group a sole establishment with an LLC, etc. So I think it's a regulatory question more than a VAT question, but I do think it's something that needs to be monitored regularly, because we see new structures coming up the whole time.
Correct. Yeah. We'll move to next question. It's from Kiran Lala. For filing voluntary disclosure, is it the net tax error, that is the output minus input, in one period to be considered for 10,000 dirham threshold, or separate 10,000 for output VAT and input VAT?
Sure. It's a really valid question. I'm going to emphasize how valid this question is, because I have read this part of the law till I'm blue in the face on the wording, and I've also got the Arabic one reread back to me in an English translation to make sure I understand it. The way I've picked it up is, and this is what we've been supporting clients on, is that where the tax payable, and that's the terminology that the law uses, and what that means is, on a particular VAT return, if you were due to pay, so when you netted everything out on any particular VAT return, you were due to pay the tax authority X and you paid them Y, and that difference is 10,000 or more, i.e. you've underpaid them in a particular VAT return, that's where you'd need to do a VD. So it's not actually the sales VAT in that VAT return being out by 10, you've got to net them off against each other, and it's the actual tax payable on the return to the tax authority or the tax refundable, which makes sense in essence, because it's only where you've underpaid the tax authority that you would need to do the VD. But it's 100% an ambiguous part of the law. But I think, to give you comfort, the tax authority guidance notes tells it that way as well. They have a couple of diagrams and it reads that way as well. So it would be on a particular return, the last two boxes when you're in VAT payment or VAT refund. If that was out by 10,000 or more, then you need to do the VD.
Definitely, that makes sense, John. Yeah, I concur with you. Next, we have a question from our Benjamin. One registrant, when started an office in another emirate, requested for group registration. However, FTA gave registration with a new number and different VAT period quarter. Can we consider it as a group registration? I think the new registration has got a separate TRN and not the group. Yeah.
So when we were talking about sole establishments, I said this is very similar to the issues we had when businesses had branches in different places and in different emirates. Look, there's still errors being made by the FTA. That's the first thing I would say, and I'm not saying that in any negative way against the FTA, but they're dealing with huge volumes of businesses, very different business structures, rep offices, branches, you know, foreign fixed establishments in the region, etc. So if it's a case that one legal entity ends up with 2 VAT numbers in 2 different emirates or something along these lines, I would say your best bet is to reach out to the FTA, because it should be one VAT number. You will not get grouping of those 2 tax numbers unless you actually fill in a VAT group registration. So it's very dangerous to assume you're VAT grouped just because it's one legal entity with 2 separate VAT numbers because of branch locations, etc. I think you need you either file your 2 tax returns and continue in that basis, but the most prudent thing to do would be to try and deregister one of those tax numbers, because you shouldn't have 2 numbers for one legal entity.
Okay, thank you. Next question is from Muhammad Abu Hanoud. What is the VAT implication for goods exported outside UAE? The agent has asked to transfer his sales commission to his personal bank account in UAE.
Okay, so the question is, what's the VAT treatment of goods shipped out?
Outside UAE, exported outside UAE. The agent has asked to transfer his commission to his personal account in UAE.
Okay, so goods and services, the first thing you differentiate in your head is the VAT treatment of goods follows the physical goods, right? So we tend to not care where the parties are. When it comes to services, we really care where the parties are. When it comes to goods, you follow the goods. So you look at where did the goods start, mainland or free zone, where are the goods going? If the supply is to supply and ship, and the shipping involves them leaving the UAE, then it should be a 0 rated export. So it would be 0 rated for VAT purposes, and the goods would leave the country without UAE VAT. And the point of that is that wherever the goods go, you're going to end up paying import VAT where they arrive, right? So that's where the VAT is captured. I don't think transferring funds to a local UAE bank account should matter. But if it's a commission or something, that starts sounding like commissionaire services, so maybe there's a service involved there. And if there's a service, you definitely need to look to where the person is located, because for services, UAE to UAE would have a charge of 5%. So it depends what you're charging for. But if it's goods exported, it should be 0 rated.
Yeah, so I think the question is, the goods are exported, but the agent has to transfer his commission in UAE.
I think it's okay, because if the commission, well, depends what the commission is for, right? The sale of the goods themselves being exported would be 0 rated. If the commission is for some sort of introductory service, intermediary service, introducing the seller to the buyer, whatever it is, if the commission is for a service, then the service is being provided UAE to UAE, right? If the money is staying here. So I think you need to look at what that commission is for. That would be the question. What is the commission for? And if it's a UAE person, body, sole establishment that is receiving that commission because of services they've rendered, and they're based in the UAE, then yeah, it would have to be UAE that.
Right. Thank you, John. Thank you so much. I think that's the last question, and in the interest of time, we'll move to the next section. Very much appreciate your time. May I welcome Ms. Dave to introduce our second speaker of the evening.
Just 1 second, Shafiq. Thank you, John Clark, for your wonderful speech. You clarified many of our questions, and I appreciate for taking your time and attending our meeting. Thank you very much.
Not at all. Thank you so much.
Yeah. Thank you, John. Thank you, Shafiq. And thank you, John, for your wonderful session today. Dear friends, investing is an incredible way to build wealth over time. The key challenge with it, however, is that investing is as much as a mental game as it is financial one. We need to have both the right state of mind and the right financial decision if we want to maximize our investment successfully. In the current scenario of world pandemic, everyone is looking forward for global investment opportunities to maximize wealth to compensate effect of global pandemic slowdown. So we have with us Mr. Yogesh Khairajani, a global market strategist from Century Financial, and it is my pleasure and honor to introduce our second speaker. Mr. Yogesh has managed over 200 training sessions at Century Financial across more than 8 decades. He brings in a wealth of experience in performance and portfolio management, risk management, financial analysis, and wealth management. His in-depth knowledge of investment and trading strategies, combined with his passion for training and interacting with the prospective client, has helped him relate and explain online trading nuisance to all types of investors. Yogesh is a qualified with an international certification of wealth and investment management from CISI and a business administration degree from the Institute of Management Sciences, Lucknow. So it's our honor to have Mr. Yogesh, and on behalf of ICI Abu Dhabi chapter, please join me in welcoming Mr. Yogesh, who will address us in global investment opportunities.
Nishi, thank you so much. I have no words. You have introduced me very well. My father still doesn't believe in all these things, but thank you so much for saying all these things. And a very good evening, and thank you so much, Ms. Joanna Clark. Thank you so much for throwing light on the recent VAT updates. VAT is it's a sensitive topic still, I think, in this economy. So there are very few people who can such easily and neatly clarify that what are the current updates going on, and this is definitely something which is connected to our businesses. So thank you so much for taking time out, and thank you so much to ICI community for coming here and inviting both of us. As far as investments are concerned, Mr. Ramesh has beautifully put this, that the times like these, of course, a lot of investment options are available, but then we still have to understand, we still have to figure out which options are the right, what is expected. And we all have lived last year, and would like to congratulate and at the same time show my support from my team for passing this particular year in good health. For those who got sick but recovered, my heartiest congratulations. And this is something which is we all have been together and we have surpassed through it. So yes, I mean the past year was very tough. The challenge is not over yet. In the beginning of the session, it was highlighted the importance of the vaccination and safety. So please do that. I mean, if you're getting this wonderful opportunity through your esteemed communities, you should do that. Now, I'll just share a small presentation which I have prepared. And this is something which can help you understand where the world is reaching towards. And we're going to talk about investment opportunities in different asset classes, in commodities, in currencies. We are going to talk about something called as thematic investing, something which these days has captured a lot of attention. And then we'll move on to cryptocurrencies, something which we have never discussed before very openly, but in the rise of the current prices in Bitcoins and Ethereums, it is our responsibility to throw some light and explain it to you, the risk behind this and what's been going on behind the rise in prices, what's the reason and what is expected 2021. And definitely before we proceed, we have to understand that when we talk about, we are going to talk about a lot of investment outlooks. We are going to talk about few strategies as well. So basically, I always carry a diary and a pen with me because I have a habit of writing when I'm talking. But then if you find something interesting, you can always write it down and put your questions on the chat, and I'll try to answer those questions by the end of the session. But please make sure that whatever outlook or whatever portfolios I'm going to share today, please talk to your financial consultants first, discuss your risk appetite with them, and only then go ahead with these strategies. Because there is a lot of risk in the markets, and we have to be very careful before we take any investment decision. So I'm going to share a lot of ideas today, but please do not execute without consulting to a financial expert or without calculating your risk appetite. Now, to begin directly, what does 2021 holds in our portfolio? Everybody has a certain amount of investment somewhere, and the purpose of investment is very simple. You want to grow your money. But then it becomes easier to grow that money once you know that what the year holds, what is the expectation, what is the monetary policy, what is the fiscal policy. And it only helps you to safeguard yourself and manage your risk ahead what is coming. So this time, of course, when we have seen pandemic, we have seen vaccines being introduced by the late November after the US election was over. So this time, this outlook depends on two very important things. One is the vaccine impact, because now the vaccine rollout has started, whether it is Russian vaccine, UK vaccine, Indian vaccine, US vaccine, Chinese vaccines, Sinopharm or Pfizer or anyone. The rollout has started, and probably in the second quarter, like UAE has a target of vaccinating 50% of it, 50% of its population by April. And there are a lot of countries which are targeting similarly. So if the new vaccines are distributed at that accelerated pace, because you must have been listening about the demand for vaccines have increased, so there is a bit of a shortage in different countries. But if it continues to go and accelerate, then we might see a broader recovery. And imagine those sectors which were damaged due to the pandemic. And what sectors they were? These were airlines, travel, tourism, cruise liners, restaurants, hospitality. All these companies. You talk about Darden restaurants. You talk about Hilton hotels. You talk about Boeing, Southwest Airlines, Lufthansa. All these kind of sectors were down because of the pandemic. And now with vaccines rollout, we have seen already a lot of increase in prices of such sectors. And these are cyclical sectors. Let me tell you, cyclical sectors means they have demand at a certain level. For example, if I'm talking about tourism, I'm talking about travel, these are cyclical sectors. At the same time, when we talk about defensive sectors are those sectors like essential products, FMCG products. Whether there is recession or not, you're still going to have your essential products. These are defensive sectors. They are non-cyclical in nature. Their demand continues to prevail throughout recession or no recession. But these days, what we are looking at is the rise in the cyclical sector, and it is expected with the vaccine coming out. So this is agenda one, the vaccine impact, how early the vaccine can roll out, and the impact of that vaccine on those sectors which were battered down during the pandemic. Second is the stimulus impact. Stimulus, there is now all the economies in the world are so habitual. Whenever there's a, we saw in pandemic what happened, trillions and trillions of dollars being injected into US economy, into European economy, into Indian economy, because stimulus is something which gives stocks and equities a greater push. So we have seen 2020 as an year from all the central banks, they injected a lot of cash in the economy. Interest rates were kept at relatively lower levels, and all they have done is keep the equities market higher. Now, if this stimulus continues to go ahead and being higher equity market. So this is something, again, we are going to discuss a bit further, that which are the sectors we should look into. But to begin with, we should always keep in mind that there are two, vaccine and stimulus. These two sections are going to have maximum impact in 2021 on all the major asset classes. Moving on, let's talk about commodities. Those who don't know about commodities, commodities are the asset class which are your natural resources. This is something which you can always, whatever comes within the earth, whether it is oil, wheat, rice, sugar, gold, silver, everything, that is commodities. And this is something which has become a part of your portfolio from last so many years, because you cannot only rely on stocks. You cannot only rely on share markets. You have to diversify your portfolio. So among commodities, we are going to talk about gold and oil initially, and then there are a lot of commodities we can always discuss later on about natural gas and wheat and sugar and coffee, whatever you like to ask. But then as of now, most important and credible commodity is gold, because gold is something we have seen gold prices moving higher during the pandemic. And this is not a very unknown concept. Whenever there is a panic among investors, people tend to buy gold. This time, what is happening? If you see in terms of physical demand, we have seen the demand for gold has actually come down, the physical demand, which means if an investor would buy gold for their own consumption purposes, we have seen that demand actually going down. But then if we see how much ETFs have invested, ETFs are, consider them as mutual funds. And these are the funds which we have seen buying more and more demands at this point of time. Now, see, what I wanted to make sure over here is the very popular opinion about gold is very simple, that the prices are expected to move higher. Now, when we talk about central bank interest rates, the interest rates are at all-time low. So this is going to keep dollar on the downside. It's still going to keep gold on the higher side. If we see a lot of mutual funds have purchased gold positions in their funds, and that is what you see the chart on the left, reportable ETF holdings and gold prices. What are these gold prices? Nothing else. But if you can see, with the prices moving higher, the graph, the line graph which you see on the left, which shows that the price is moving higher right here. These are the gold prices, and this is the gold chart which we have seen going higher. The ETF holdings, which means the fund, the investors of the funds, they have seen that they have been buying gold more and more. So if you see this increase from here to here, this is what the mutual fund managers have also entered while we have seen the increase in the prices. So while we see the world gold demand still coming down, the prices of gold have started going higher, and it is very normal. Why the world gold demand has come down? Because gold prices have continued to go higher. So as a consumer, as an investor, you will resist to buy gold when the prices are at a higher rate. And that's why we have seen the world gold demand coming down. But then what pushed gold prices higher was, one, the central bank interest rates, which were kept low. Second, the fund managers who have been buying gold with the increasing prices and putting in their funds. So this is something, these are the two things which have kept gold prices higher. So the popular opinion as of now is that the gold prices are expected to go higher. But one thing which you should always remember, why I said this is a popular opinion, because investors see this as a no-brainer. They think that, okay, there is still uncertainty and the gold prices will continue to go higher because interest rates are low. One thing which you have to make sure, and I was talking to my senior analyst, and he also pointed this out, that currently, because there is so much of injection of currency in the economy, and how this injection happens, how this currency injection in the economy happens, the central bank starts buying government bonds. And more bonds being purchased by the central bank, which means more cash gets injected into the economy. And now with so much of bond buying, the supply of bonds have increased, while the price of the bonds have come down due to higher supply, and lower prices have increased the bond yields. Now, when that happens, increased bond yields is something which you have to be very careful, because that might force the central bank to increase interest rates and then pushing the gold prices down. So this is one specific point which you have to keep in mind, and that is the rising bond yield, which was not before January. So when people were talking about an outlook in 2021 during November, December, they were clearly bullish on gold, and they are still bullish on gold, which means they're expecting prices to go up. But then you have to be very careful with what you listen, and please keep a close check on the bond yields also. Second is the crude oil. Now, we are maintaining a very neutral status on crude oil. A lot of people must have seen oil prices shooting higher. Reasons being, US is extremely cold, so a lot of oil refineries were being shut down due to the snow, and the supply suffered. And second thing, Saudi Arabia came up with a unilateral production cut during the OPEC meeting that also pushed in the oil prices higher. Now, this is something which was not expected, but we saw a production cut and we saw oil prices inching above $60. And you must have seen 2020 April was a disaster. We have seen April prices, oil prices going negative in April, and now it is around $62 or $63. So with oil, few things which we have to understand is, of lately, Iran has announced that their enrichment capacity will be increased from 20% to 60%. Now, this is a dangerous situation because Israel on the other side is very quick on reacting, and they have already disclosed that if the enrichment capacity of Iran increases, then Israel will be on the top to defend that. Now, this is a Middle East political issue, and geopolitics have always played a very important role in oil prices. That's why a bit of uncertainty we have seen oil prices also going higher for that particular reason. Because earlier, with Joe Biden as the new president coming in, the idea was that he will reestablish the nuclear deal with Iran, which was shut down by Donald Trump, and maybe the Iran will start contributing to the oil again, to the oil supply again. Now, this was one thing which was going against the oil prices because again, excess of supply comes in, prices drop. But now with the geopolitical issues, there is an expectation of oil prices to remain slightly higher because with vaccines rollout, the global demand might again start picking up, and inventories have shown signs of that. So we still remain neutral on oil prices, but then if you need a range that will be around $55 to $75 is something what the range is expected to be. And currently the Brent oil prices have been around the $63. So this is something which you can always look. Followed by the currency outlook. Now we discussed about oil. Now what about the currencies? The chart which you are seeing currently right now, this is a dollar trade weighted chart. Trade weighted dollar chart means through this particular graph, they are representing the performance of dollar against those currencies which are its major trading partners. Not against all the currencies, but those currencies which are the major trading partners. So that's why I'm showing you a trade weighted chart, because that makes a lot more sense. US dollar is expected to be weaker also for the 2021, although the impact of pandemic has still not been clearly seen. If you compare pandemic and how dollar has worked out with the lower interest rates, this fall is nothing. So there is a lot more bearish market for dollar which is expected. And I think apart from the interest rates which are expected to be kept low, of lately the Central Bank of US, they have already announced they're going to keep the interest rates low until even after the inflation reaches to a certain point. They are waiting for inflation to go high. They want to keep the interest rates low till then. And at the same time, they want to monitor the economy once it starts progressing. So there is no deadline to this, and the interest rates can be kept lower for an indefinite period of time, and that has kept dollar low. That is one thing which is from monetary policy side. Let's talk about the US politics as of time. Those who have attended my session before the elections, we had talked about a possibility of a complete democratic sweep. And if you see, it has happened. The House, the Senate, the White House, all three are now blue, ruled by Democrats. So now passing any policy by Joe Biden is not going to be very difficult, apart from few policies, of course, where the opposition Republicans have a say. But otherwise, they have already started injecting a lot of stimulus in different sectors. And now we can see also Biden's government policies are actually very negative for dollar, because he's talking about increasing the corporate taxes, increasing the minimum wages as well. And this is something which was not done during Donald Trump's time. The corporate taxes were low, but with Joe Biden, again, there is expectation that corporate taxes will continue to increase. So this is something which is going to keep the dollar weaker. And at the same time, if you see other currencies which are related to emerging markets, other currencies, I'm talking about INR, I'm talking about Euro, Pound, they are also expected to be positive. So this is something which is, so if you see the very next thing, we're talking about Euro, and for the European economy, the biggest question is still the lockdown. If they don't do the lockdown well, then again, the economic activity could get dampened and we might see Euro getting affected by it. But then as of now, we have seen the Europe as a country and Euro as a currency, the balance of payment is much more healthier than US. And if you, so just to neatly define this, that their inflation rate is still much lower than their interest rates, which in US is not there. So we have seen the purchasing value of Euro as a currency is much stronger as of now, which is expected to be better in 2021. This Euro also is the world's most second traded currency. So this is, if dollar is expected to go down, dollar is one of the largest traded currencies and Euro is the second largest. So you can kind of see whenever Euro gets, dollar gets weaker, Euro most of the time might surprise you and start going higher. So this is something which is, that's why we are giving a bullish outlook to the Euro. And Euro, if you see the chart, I have my live platform on and soon we'll finish the presentation. We'll go to the live platform also, where you can discuss about how Euro has actually broke resistances and moved higher. So we have seen Euro as a currency still going stronger and it is expected a stronger outlook as well. Same if you see Great Britain pound. We have seen, if you see the Great Britain pound, it has actually rallied in last few days. It has gone to 1.40 and 1.41 levels, something which was seen around 2016 when Brexit referendum was going on. So, and if you see here the relationship between, now this dark green line over here, this is pound right here, and this light green is the UK equities. So we have seen currently, if you see US equities still almost very close to the equities went down while we see pound going higher, and the UK stocks now are expected further to grow more because they're still undervalued. Entire 2020, if you see, pound started appreciating, it came down, but US equities have been very underappreciated if you compare it to US and Europe. So first thing, right now, if there is a global vaccine rollout, first UK gets very much impacted because UK had a lot of cases, and now if you see their daily infections, it is reduced. And I'm talking about a data which is taken yesterday itself. The infections of the year at 8,489. Now, this means 1 in 3 adults had received a first dose of COVID-19 vaccine. This is something which is really good, and that can rebound UK equities and can be really strong for pound as a currency also. And you have seen the impact on pound. As I said, I'll share the live platform and show you how GBP has started going higher. So even for pound, we are expecting a stronger. So if you see most of the rivals of dollar, which is euro and pound, they're expected to be stronger, while dollar is expected to be on the weaker side due to several factors. Followed by yen. Dollar and Japanese yen is traded a lot. And one thing which is important and you have to understand about Japanese yen is it also acts like gold in terms of a safe haven. Japanese yen is also safe haven asset because credit in Japan, loan in Japan is very cheaper. So whenever there's an uncertainty, people don't give dollar the same benefit of doubt as a state as a safe haven asset class, because now yen has actually covered that position instead of dollar. So whenever there is a panic, you will see yen getting more stronger along with gold and dollar getting weaker. This is the chart which you see right now. It shows that how big life insurance companies and retail sector, they have stopped buying government bonds outside Japan. These are Japanese retailers and Japanese corporates who have now started lowering their exposure in the overseas assets, and they are buying more and more assets within their home country, within Japan. So this is something again which is very good, and this is something which can make yen more stronger in 2021. And following dollar as a weaker currency, which is the anticipation, yen is definitely expected to be on the stronger side. Followed by, I'm sure most of you right now must have put questions regarding what is expected from a dollar INR and INR as a currency. So guys, what you have to understand is even last year we saw Indian rupee getting weaker a lot in spite of a lot of foreign investment, stock markets going all-time high, and we saw a lot of movement in the stocks. But obviously, the oil prices, we have seen a lot of depreciatory pressure on the rupees due to, from oil prices, they have started increasing. There has been a lot of monetary easing also. Now, that is something, a bit of strength INR has still achieved because dollar continued to be weaker by continuous interest rate declines. Now, the global economy is expected to improve and get out of that zone of the pandemic. Not completely, but with vaccine rollout, again, we are expecting the economy to start functioning and start getting back on track for this year. Now, this is making Indian assets very attractive because there are a lot of emerging markets which are undervalued, and India is one of them. Their growth rate is expected to bounce back sharply, and obviously more of the foreign investment is also anticipated, and it can be in the form of stock market. So Indian currency and Indian equities remain again a very strong candidate for the bullish investments. Now, if we talk about the stocks in itself, stocks and bonds. Now, US and non-US equities. Of lately, everybody has talked about Teslas and Amazons, and I'm sure these are the companies which people would always like to invest into. And this is something which a lot of people are listening. You use an iPhone, you use Microsoft system, you drive a Ford or a Volkswagen, or you wear Adidas and Nike, you eat at McDonald's, fly in a Boeing, use a MasterCard or Visa. So lot of our lives actually revolve around US stocks. We may not know it. We may be inclined towards our domestic equities more. Everybody has love for the companies from the country they are from. So obviously you do invest a part of that. But you also have to understand that we have to diversify US and non-US both. As of now in 2021, non-US equities are much more attractive given the post-vaccine recovery will bring the undervalued cyclical stocks. Cyclical means, as I said, companies related to travel, tourism, restaurants, which were shut down due to the pandemic. And now with the post-vaccine economic recovery, we might see those stocks moving higher. So try to identify those areas. Otherwise, obviously, I mean, the Teslas and the Pfizers, these are there. But the point is, you don't have to be very focused on what the noise is. You have to find out that what's happening next, what is expected. Investments is all about minimizing your loss and reducing your risk. It is never about making a profit. At the end, you want your money to grow, but then the most important thing is that how you should minimize your loss or minimize your risk. Now, coming next to emerging market equities, as I said, emerging market stocks like China, for example, they have exited from the lockdown. Stimulus measures, they are adding more and more cash into the economy. That should definitely benefit more and more emerging markets and the recovery in global demand with a weaker dollar. So emerging market equities, emerging market currencies are also very attractive as we are expecting dollar to go down and other rival pairs as euro and pound to remain higher. Now, stepping into the bond market, investment grades and government bonds. Government bonds are the bonds which are issued by the government, while investment grades are those bonds which are highly rated, have a very low risk of default. The investment grade as of now, slightly expensive, but if again the post-vaccine outlook, we might see them getting better. This was something which was talked a lot about last year also. Try to invest into emerging market bonds, but dollar denominated. I think that is something which you can look into. As of now, in fact, we have seen, we are talking about the emerging market currencies. We are talking about how emerging market currencies are expected to be stronger. But when it comes to bonds, we are talking years and years. We are not talking about 1 year, 2021. So I'm sure that's the question somewhere, that if we are expecting dollar to remain weaker in this particular year, then why would we go with a dollar denominated emerging market bond? The idea is that a bond could be for 5 years, could 6 years, 10 years, whatever it gives you. So in the longer run, we always expect dollar to bounce back. So this is something which you can do. Look for emerging market bonds, but should be dollar denominated. That can help. Government bonds, the yields, as I said in the very beginning when I was talking about the outlook for gold, the government bond yields are growing higher. And that is because of the excess of the supply of bonds central bank has been purchasing. So there's been a lot of bond supply, but the bond yields have fallen due to bond yields have gone up due to the falling prices. So this is a very important reason that why one should look into the bond yields today. There is a strategy how you can safeguard your portfolio against the rising bond yields. This is something which I'll discuss about. Moving on to something what I discussed before, but I see a lot of new members and a lot of new names, not new members, but new names, of course. We discussed about thematic investing, and this is something which continues to grow. Thematic investing is specifically when we're talking about few themes which are not done just because they are profitable. Thematic investing is now a concept where people are investing very much into electricity vehicles. They're investing into those companies which can capture your health data digitally and can help you in medical consultation remotely. This is the year of, we all have seen that how remote lifestyle, work from home lifestyle took over when the pandemic happened. But it is not over yet. And this is a living example what I'm doing right now. We are connected on Zoom as of now, doing this session. Am I not vaccinated? I am. Are we not wearing masks? We are. But we still are taking precautions. So this is a living example of how the work from home or remote lifestyle, this is also expected to continue. So similarly, there are some areas, medical consultation via remote process, electricity vehicles, those companies which are working on this, increasing the speed of internet, because internet traffic has increased so much now. Anything and everything is available for internet. Now this can bring a lot of congestion. Now there are those companies which are working on increasing the speed of internet traffic, and that is also something which is a very highlighted area. This is something which has started picking pace. DNA sequencing. A lot of pharma companies are working on to find out that how effective strategies can be used for DNA sequencing, and there are a lot of companies which are doing that. Digital payment. Talk about PayPal, talk about Square Payment, talk about Visa, MasterCard. Visa and MasterCard have shown phenomenal growth. So digital payment is also something which is here to stay, and a lot of investment opportunities in there. Then wind capacity, as I say. So thematic investing is most inclined towards climate, improving health, improving empowering people, reducing gender gaps. Those kind of companies people are investing into. Earlier, it was a very popular opinion that you cannot invest into these kind of social companies which are working towards environment and health and empowerment, at the same time make profits, because this is something which is it's very simple. If today I am trying to save environment and paying an extra cost to dump the waste at a dedicated area, I have to pay a cost for it. It reduces my profitability as a business, but it does very good to the environment, right? So that's why the social investing was never a popular concept. People thought that, you can do that, but it's never going to give you the desired return. But now, if I show you how the renewable energy basket, how the social investing basket and funds have increased, they have given almost higher returns than the actual S&P 500 and other US market indices. So this is the something which is expected to continue, and it is only going to get better. The important reason is now people are more aware of what is happening. Electricity vehicles, Toyota, Tesla, BMW, Volvo, all these companies are working towards EV. And we have seen how Tesla has already gone higher. And we are going to talk about a portfolio which will have an electric vehicle company also right away. So this is one thing which is expected to go for a while. And last but not the least, let's talk about what has been the news in the last few weeks, the cryptocurrencies, the crypto era. The chart which you see right now, right here, this, and now this is, obviously it looks like I just drew it from the hand, but this is what has happened overnight in cryptocurrencies. We have seen few reasons. We saw this Bitcoin rally or cryptocurrencies rally in 2017 also. And this was because of the retail investors. They started entering, investors like me and individuals. They started buying more and more, and that was retail rally. 2020 rally was by institutions. The companies like Square Payment, which was founded by the same founder who was the founder of Twitter, Jack Dorsey, the CEO of Twitter, Jack Dorsey, founded Square Payment. Square bought $170 million worth Bitcoin, and they have exposed this particular position of theirs, and that has added why cryptocurrencies have gone higher. So this is one. Hedge funds are buying a lot of cryptocurrencies. Elon Musk, Tesla, tweeted that they have bought $1.5 billion worth of cryptocurrencies, Bitcoins, and in future, they are planning to make this as an effective mode of payment. Now, that is something which has pushed Bitcoin prices literally from $10,000 to $50,000 per coin. With now, the point is, what happens to cryptocurrencies, and what is the idea? Now, as I'm saying, that the recent rally is because the institutions have entered. So this is here to stay. You see that October 27, we saw JP Morgan introducing a JPM coin, and JP Morgan was the biggest critic of a cryptocurrency. On last October, they came up with their JPM coin, which is a digital currency. November 18, we saw Mexican billionaire Ricardo Salinas Pliego, 10% of his assets were invested into Bitcoin. 12th of December, we saw the Mass Mutual purchases from the insurance. So insurance firm, the Mass Mutual, they purchased $100 million in Bitcoin. So institutions are entering now. This is the difference between 2017 and 2020. So that's why when we are looking for the outlook, we have to understand something over here. Look at this, the moment when it was announced by Tesla over here, it just moved up to $43,000. That being said, we always should remember that cryptocurrencies are still a very speculative instrument. You don't, if you're planning to buy and keep it for a longer term, you really have to understand that this to $10,000. I'm just getting a message here that my audio quality might be not well. I hope everybody can hear me. Okay, I'm just going to go ahead and speak. I hope my
yes, we can
voice is clear. Okay. Just got a message here that said that something's wrong. Never mind. Thank you. So what we can see is cryptocurrency as a currency. It's good for speculation. In a day, it is moving around $10,000, $5,000. So as of now, it's a very good mode to speculate. But investment, not really, from someone who is trying to exhaust his savings and expecting a dedicated return. This is not the right asset class. So please eliminate the noise around you. Don't have FOMO, fear of missing out. I'm still getting a lot of queries from a lot of investors that I want to buy Bitcoin. The long-term target for Bitcoin is given by a lot of firms: $146,000, $200,000, $300,000. But you have to understand, as of now, only if you're investing long-term into a cryptocurrency, invest only that money which you can risk to lose 100%. Because cryptocurrency, as of now, there are a lot of lately. The US Treasury Secretary Janet Yellen, she pointed this out, that Bitcoin is not, in the near future, will not be accepted as a medium of transaction. So this is something which that has pushed the Bitcoin prices down by $10,000 on one single day. We'll see the chart right away. And then again, Square payment today, when they disclosed that they have $170 million worth of Bitcoin, we saw cryptocurrencies going high. So it's very speculative at this point of time. So be very careful. You can do day trades in cryptocurrencies by putting stop losses, but long-term investment, please make sure that you do not get carried away by noise. There are a lot of stocks, a lot of undervalued stocks, which are good for your long-term investments. Lot of ETFs, lot of share baskets which you can invest into related to themes like 5G technology, remote medical lifestyle, work from home stocks. Those companies, those cyclical companies which are undervalued, like airliners or travel tourism, after vaccine rollout, those kind of companies can get a very good boost. So you can invest into those. I'm going to discuss some strategies which I said, and some portfolios also. And you can get a copy of these portfolios once this session is over. Normally, these are prepared for the clients and share it to them, but obviously, being the member of ICI, you yourself have the privilege to access of these reports. Please, if you have any questions, keep writing over here, and I'll try to answer these questions the best of my ability. Right. Okay. Now I have a lot of strategies open in here, and I'll start. Okay, let me start with the portfolios first. This is something which is a longer term portfolio for those investors who will have doubts about, because not everybody is a day trader. So I'm sure all of you must have questions. You want to buy something for a longer period of time and hold on to it. Then what are these companies? So this is. Please do click a picture if you want to, or I'll try to send these to all the members via PDFs. Now, this was actually prepared for a client, as you can see, and this has 70% allocated to, so 15% allocated to gold funds and 70% allocated to equities. So, and 15% again to bond ETFs. So this is a portfolio which is mixture of gold funds, bond funds, and then stocks. I'm not talking about day trading here. Day trading is something which we can always discuss one-on-one whenever you guys have time. So currently you are looking at stocks like, begin with FV, GoodRx, Snowflake, Teladoc, DraftKings. I'll give you a very quick snapshot of what these are. ETFs, gold ETFs, which are available over here, and some bond funds also, which do not have the alternative city tax and alternative management tax, because a lot of bonds have alternate city taxes, but these particular funds, they don't have those taxes. So I'm sure, being a CA, that would be your first question about. But then these are the funds which do not have taxes in them. As far as the stocks are concerned, this is a mixture of biotech companies, every very popular company which has a very good dividend also. US stocks, they have dividend tax which gets deducted at source around 30%, and then you get the real dividend. So I'm already telling you most of the US stocks have, but the bond ETFs, the bond funds which I have mentioned in this, they don't have alternate city taxes. So this is something which can be of work. AbbVie is again a very popular stock in biotech. Good dividends are received over here. They #1 selling drug in the world, which was Humira, and what happened was they did lose their patent protection, but then we saw again they did one acquisition, and that worked out for them. We have seen a lot of new products coming from AbbVie, and this has again being produced with Johnson & Johnson. This has been produced with different other companies also. The sales have been increasing, and on the earnings front, their numbers are very solid. Their revenues have increased by 52%. Incomes have also increased. So this is something, again, guys, which you can keep, because the dividend yield is around 4.9% for the year, and it's a pretty good dividend for a biotech company. So for a longer term, if you hold it for 1 year, your whatever investment you do, 4.9% is the dividend which you receive on these shares, and this is something which is exceptional, given the fact it's a biotech company, and again, they're doing a lot of medical advancements also. Followed by GoodRx. It's again a healthcare technology. We're talking about a lot of such companies that have become very important in US, and most of their relevance was seen during the pandemic also. It has some competitors as well, but then we have seen GoodRx completely showing that how niche they are into their markets. Because if you talk about healthcare needs of any individual, they are much more cheaper, and there are a lot of low cost options which they provide for medical consultation. Snowflake, IT, let's not eliminate IT completely, given the fact that how technology sector has outperformed entire 2020. You can always keep those stocks which are into first cloud computing, very, very important sector this year and in the coming years, and data warehouse. Now, cloud computing is something Amazon is doing it, and Amazon stocks have been going higher. Microsoft is doing it, Microsoft stocks have been going higher. Amazon's 15% revenue now it comes from the cloud computing. Jeff Bezos, he left the designation from the company and gave it to the guy who started the cloud computing segment in Amazon. So cloud computing is very important, guys. Snowflake is one of those companies which you can look into, and always take an opinion from the help of the financial experts. What should be the good buying or the selling price? Teladoc Health, something which is remote medical consultation, got a lot of eyes on the pandemic, because you could call 24/7 service was available, and you can have a medical consultation on the phone. So Teladoc Health, the name itself comprises of the fact that you can get a remote medical consultation, and the prices, if you see, the profits have doubled. They have like hit 2.8 million visits in the second quarter, which is 200% higher in 2019 from 2019. So this is again something which is a futuristic stock we are looking at. DraftKings is its fantasy sports. DraftKings it's mostly hotel, restaurants, and leisure. It's again one of those areas where you can actually look into different. So this is one of those areas, fantasy sports and hotels and luxuries. They are into different areas, and those are some areas which are again like fantasy sports. If you talk about Dream 11, Boomer 11, in a lot of international areas, fantasy sports is something which is a very good business. Hotel luxury, this is going to improve once the vaccine rollout happens. So obviously the stock has all. Digital turbine, now we are talking about much more again software related companies. We're talking about 5G related companies. So this is again Zoom Info Technology. So many people must have heard about Zoom Info. Not Zoom Technology, Zoom Info. If you search on Zoom Info right now in your system, you will see that this is a website which has a database of a lot of people, their information, their emails. With the pandemic and work from home status, a lot of people, if they're not going out, they can sit at home, they can still generate leads. So a lot of improvement can happen through this particular company. So Zoom Info Technology is again one of them. Then there is Clover Health, followed by Lemonade, which is an insurance-based company, and then Vroom, which is e-commerce for second-hand cars. You must not have heard about this company, because this is again a very encouraging market sector. It is moving and it is increasing day by day. Online used car buying platform, a number of solutions for consumers, including reducing the time spent at traditional dealerships while also satisfying their desire to complete more of a vehicle purchase online. So again, used car industry is highly fractured. Only top 100 dealers account for 8.6% of the market share. But then we are talking about a long-term portfolio, right? So these are the companies which might be smaller now, but expected to perform better over a longer period of time. Then there is Xpeng, which is a Chinese company, electronic vehicles company. Definitely should diversify other than Tesla. A lot of investors talk about Tesla, and for me, I believe other than Tesla, you can look into Xpeng, you can look into companies which are Toyota, who are coming up with their EV vehicles, which much more efficient batteries. Data Nexus, which is internet and direct marketing, again, a Chinese company, local on-demand retail website for the brand owners. Chinese crowd has a lot of loyalty towards their brands. So that's why we have seen Alibaba moving higher. We have seen Xiaomi. We have seen a lot of companies from China just because their crowd is very loyal. So this, and anyways, Chinese economy has bounced back the first from the pandemic. So this is still, the e-commerce is still going on in China, and the e-commerce market in itself is increasing a lot. So 1 billion orders were delivered in the first 3 quarters of 2020, which was again an increase from the same period in 2019. Even the third quarter of 2020 was very encouraging for the firm, right? And then, of course, there is a SPAC portfolio, which we have very less information about. Now, SPAC portfolios, guys, this is, again, I think we have a shortage of time, but then I'll quickly explain it to you. SPAC these are shell companies. Normally, you must have heard about IPOs. And this is a very unique concept. And if you listen me out, you will understand this. Normally, the IPOs happen through the actual standard. If I want to list it on IPO, I have to fulfill some criteria. There are some companies which cannot fulfill those criteria. And they get acquired or bought by some shell companies of the main company, like Goldman Sachs, for example. Goldman Sachs created a shell company only for the purpose of buying another company which wants to get listed for the IPO. So such kind of companies are called special purpose acquisition companies, which means that special purpose is to acquire a company, and then that company can get listed for the IPO because the financial resources are given by the SPAC related companies. And these shell companies are created by bigger companies like Goldman Sachs, JP Morgan, and others. So there are a lot of SPAC. And why I'm talking about this now, this is not a very new concept. This has been going on for years. There are a lot of companies which has not come straight through IPO criteria. They have come through these shell companies. But now in 2020, we saw that the rise in SPAC-related IPOs have increased by 50%. Now that's a huge number. So we started looking to those companies which are into SPAC, like Churchill Capital Corp. This stock came down very recently, but this went up the few days ago. It came down yesterday itself because acquisition was supposed to happen. It did not happen. It came down. But Churchill Capital has increased. Look at this chart. This has been going just increasing higher and higher. Look at this chart. So these are SPAC companies. These are something which is risky and volatile. Investors with a high risk appetite can always try in SPAC companies. Investors with a conservative risk appetite should not look into this particular portfolio, right? I have few more portfolios, Mr. Shafiq. If we do have time, 5 or 10 minutes to share more, can I share more, or we are going to take questions away? I can anyway send these portfolios to the members via emails.
I think we can still go for another 5 minutes, and then
we can, right? Absolutely. Thank you so much. So this was one portfolio which we prepared for the long-term clients. But again, guys, even in this, the risk appetite is clearly mentioned. We are talking about the ones who are creating, who are looking into SPAC, like special purpose acquisition companies. You have to understand that this is something which is for higher risk investors, right? Now, coming on to one more portfolio which I wanted to talk about, especially Chinese companies, because we talked about emerging market stocks. So there are a lot of companies, even in emerging markets. We already discussed about Xpeng, and we looked at Data Nexus also. Kingsoft Cloud, again, as I said, the cloud infrastructure companies. Now, these are Chinese companies. instead of taking more and more exposure to US, this can allow you to diversify at different sectors. So this is something which you can look into from if you are trying to diversify on a different scale or different country. One Connect, again, this is technology as a service platform for financial institutions in China. Again, cloud technology solution that integrates into financial services industry. Now, fintech in itself is a very important concept, financial technology revolution. There are funds which are providing financial technology, and One Connect is such a fintech stock. This has been, if you see Chinese economy, it is becoming more and more digital with the e-commerce industry rising, and now the only need of the hour is even the financial services are expected to be much more digital, and the research and development is also increasing to a certain level. There are companies, music entertainment like Tencent, Baozun, which is again a company which is related to e-commerce. So you see a lot of stress has been given to e-commerce companies related to China, because when it comes to US, we only know about Amazon. And there is no other company we know about. So this kind of portfolio opens e-commerce market, which is the market which is here to remain, because pandemic or no pandemic, e-commerce provides you an ease. So that is something which you can always look into. And this is another area which you can diversify into. And a lot of things are happening by Chinese equities also. Because with Joe Biden coming in, one thing which is missing is Donald Trump's tweets at this point of time. I'm sure everybody agrees with that. And I'm sure US will still have a very strong stand on the US and China thing. But with Biden coming in, there is a possibility of a global trade getting back on track, with Chinese equities also again getting valued fairly. So these are few stocks which, again, the portfolios I can share with you. And these are again stocks related to healthcare, technology, the same sector which we did in US, similar sectors but in a different economy. Very quickly, for those people who love to have more dividends in their portfolio, this is one portfolio which has good dividends, around 7% yield dividends, and the companies which are there are mostly consumer defensive stocks. Something, even if the recession hits, these stocks will be very less sensitive to the market movement. Plus, they will give you a fixed dividend and an income. So you are looking at the companies which are related to real estate development, and those real estate companies whose maximum holdings are government-based. So this is also something which can be really helpful in determining the risk. Looking into consumer defensive stocks like Imperial Brands, Vodafone Group, again as a communication service, Orange, which is a European consumer telecom provider, then Philip Morris, which is a tobacco-based company. All these companies have an average dividend yield of this particular portfolio is around 7%. So if you buy all the stocks and keep this for the entire 1 year, you get around 7% yield on your portfolio. Plus, these are less volatile to the market. So that's something which protects you from high volatility also. Right? And this was the last one which I wanted to explain it to you. While the bond yields are rising, how you can actually keep your portfolio safer against the rising bond yields was by buying a US banks basket, and you can short sell US gold basket. Now, I told you in the beginning that we are expecting gold prices to go higher, which is a popular view, but bond yields have started rising due to oversupply of bonds, and with prices of bonds going down and yields going higher, the one sector which will get benefited will be the US banks. So you buy a US bank basket, and buy share basket means few companies clubbed together in a basket, which is actually tradable. And you can do this on a platform. So you can buy that basket, but short sell. Short sell means you borrow the basket from the broker and sell it at the market price. When it comes down, you buy it back and get a price difference. Something which I'm available for a one-on-one session also. So anyone from the community wants to understand, our services will be extended. So you short sell a US gold basket, which will counter and hedge your portfolio. So if the bond yields continue to go higher, your US banks basket will go up, gold basket might come down, giving you profits both the sides. In case if gold basket is going higher, irrespective of higher bond yields, then we might see bank basket also going higher. So your portfolio is hedged. Wrong thing only can happen is in case if the bond yields go down. So if bank starts going down and gold starts going higher, that's where you make a loss in this strategy. Again, so as I said, please do consult your financial experts. Do talk to us before you enter into any of these strategies. There are a lot of portfolios which I still have in my box, and that is something which we are customizing for everyone as well. Right, guys, I can take a few questions if possible. Anyone has questions? Okay.
Thank you, Mr. Yogesh, for sharing your experience on global investment opportunity. I'm sure our members must be now very comfortable in choosing their funds in their investment portfolio. Thank you so much. We have few questions. I'll just hit. We have a question from CA Rajiv Nanda.
Yes.
He's asking about the view on Australian dollars versus US dollars.
So, as I said, the very popular view is dollar being weaker, and a lot of currencies are getting an advantage on this one, because with dollar expected to remain weaker and global trading getting back on track, we might see Australian dollar getting more stronger as compared to USD, because Australia and China are very strong trading partners. With Chinese economy rebounding, entering Joe Biden into the picture and making global trade much more easier, we might see Australian dollar also bouncing back, while dollar is still expected to remain lower. So that is something which is expected. For actual target support and resistances, I can actually plot out on the chart and definitely discuss with you, Mr. Rajiv.
Thank you. Mr. C.A. Ghalib is asking, like, normal belief is that lowering borrowing cost, low interest should push bond price high. But in the recent past, we have seen a higher yield expectation dragging down the bond price. Do you think it is an irrational behavior or investor adding a higher credit risk?
So again, Mr. Ghalib, very good question. I mean, absolutely, this is something which is when we hear about lower interest rates, our brain automatically processes the information. It's a low interest rate. So first thing we see is, okay, gold price is going to go higher because we expect a weaker dollar. What you said also is, when we are talking about a low interest rate environment, what has happened differently in 2020 and 2021 due to the pandemic? Massive injection of stimulus, and US government's first mode of doing this stimulus is bond buying. And even the bonds which I'm talking about, these are investment grades. What I discussed in my presentation, those investment grades which have a very low possibility of getting defaulted. So central banks have started buying those bonds, and in massive quantity. With Joe Biden coming in, again, there is a massive stimulus which is being injected. That is the reason of excessive bond supply. And now when that has happened, this excessive supply of bonds have pushed bond prices down, and that's why we see yields getting higher. So that is the reason a lot of stimulus being injected. And again, pandemic was it was not a normal activity. So this is not something which was expected. But then with this happening, as I said, the strategy which I discussed with you, with the high raising yields, the financial sector is going to get benefited the most, and gold prices might drop. And we have seen a decline in gold prices in last 3 to 4 days. So try to be long on the financial sector and short on the US, like the gold mining companies. I think that can give you a proper hedge over your portfolio.
Okay. CA Deepak Jain is asking, like, what is your view on silver? Like many industrial commodities, for instance, copper, which is all-time high. Can silver make also a new high?
So silver has actually, if you see 2020, silver has actually gone way higher than it used to be in 2018 and 2019. Silver as an industrial metal, it normally follows gold in terms of the trend. But as an industrial metal, with copper improving and with Chinese manufacturing coming back, we might see silver prices also going higher. And see, I'll give you one more perspective towards this. Many times we know that gold and silver always go higher, but silver is not a safe haven asset. So silver is more so an industrial metal, as you rightly said. So we might see silver prices this time pushing higher. That being said, we are talking about the physical demand increase, right? But during 2019 and 2020, silver prices spiked a lot. Now, with that particular spike in 2020, the only concern which you have is the spike which happened was during the pandemic. That means demand, lockdown, demand was not that much, lockdown was not that much, and we saw the increase. Something what happened with the pharma stocks, Pfizer, Moderna, Novavax, these stocks went up before the vaccine rollout happened. So now when the vaccine has happened, nobody's buying Moderna because that rally has already been priced in. Something what we can still witness in, that's what we can witness in silver. Silver prices may not give you a very drastic bounce back because it has already reached $30 and the global production has not even increased yet. The lockdown got over and we saw a slight increase. Silver has a strong support around $23. That should be a buying on dips. But as of now, at 27 or 30, I don't think it should be a buy. I still feel that a decent buying level is around $23 or $21 because the rally which has happened is not only because of the lockdown removal or increasing the manufacturing. That is still yet to come. So this rally, what we have seen was more speculative and it is all right now it is already being priced in. So have a very neutral view on silver, good buy levels at 23. That is what I think we should stick at. It's a buy on dips and around $22 to $23 levels.
Okay, CA Samir is asking like, would there will be another Reddit pop, another euphoria, or retail investors so naive in US?
Yes, retail investors are very naive in US, and I was surprised, Mr. Samir, as well as you, because these days markets just work on rumors, sentiments. It is the insanity. Let me show you what we did out there, and this will explain you. See this. The question what you have asked, a lot of people asked, and what I was quickly able to do was come up, make a list of those companies which could have the potential of being next GameStop. And this was again something we did mention this. These stocks are highly volatile, can be very risky for investors. So anybody who invests, please make sure and understand your risk. But look at these companies. Look at short interest percentage. Short interest percentage means what is the percentage of investors selling this stock, not buying it, selling this because they're expecting it will go down. The companies like Dillard's, Big Commerce, Kubo TV, Bed Bath and Beyond, they had massive selling interest. And do you know the silver prices went up from $27 to $30 just because somebody boosted this on Reddit? This happened to a commodity also, and that was silver. And the very next day, silver came down from 30 to 27. Now, this has happened just after the GameStop phenomena. And these were more other companies, out of which the first 4-5 stocks, they already went up after GameStop and then again came down. So currently these stock prices have come down again. This Reddit phenomena as of now has died out because silver prices happened, then GameStop happened, AMC happened, and after that all these few stocks happened. It has died out now, but something similar to this event, if it happens in the future, will it get the attention of the investors? It definitely will, because we are living in the era where cryptocurrencies and bitcoins are moving $10,000 in a day, and investors have major FOMO. See, understand buffet philosophy anymore, that you buy a stock and keep it for 20 years and invest into business. It's not. Now investors are focusing on the changing world, which is digital technology, electricity, vehicles, stocks like Tesla and everything. So yes, I mean, there's a lot of noise in the market, and that's why you need your financial consultants next to you who can eliminate this noise and explain you the risk and rewards neatly. I think we have just one more question.
We have one more question actually from CA Galib. He's asking like, how scheme of ESG investing, do you expect high alpha on these themes? On this theme?
Absolutely, Mr. Galib, very, very good question actually. So ESG investing, for those who don't know, ESG stands for environmental, social, and governance form of investing. And this is something which a lot of people have asked. Let me quickly show you. This is a share basket which we have, which is related to renewable energy, just right now, just clean energy as of now. Look at the movement which has happened of lately and see the increase in the prices also. So that's why I've opened this, increasing the size of the text. This is the pandemic fall right here. So that time the price was around $5,000 for 1 unit. It went down during the pandemic, Feb, March. It came down all the way to $3,000. After that, we have seen the prices from this particular price going further all the way. See this. Now, this after the pandemic, and most importantly, after the US elections. Now, this is where I'm interested to show you. This was November, and this was the price. This is renewable energy. So this is the basket which has all the renewable energy-based companies, clean energy-based companies, basically. From $8,000 in November, this basket did go up to almost 14,500. That is, again, as I say, more than 50% of return from November, December, January, Feb. 4 to 5 months, investments going up more than 50%. It has come down now in March with the high bond yield. We have seen stocks coming down from 14,000 all the way yesterday to 11,000, and now today it is trading at 12. Renewable energy, Joe Biden has put $2 trillion of stimulus in renewable energy stocks. So clean energy, something environment-related stocks definitely are getting a lot of boost because Biden has been very clear in saying that they will ban the fracking of oil and fossils. So this is one area. You can invest into something called a social ETF. This is KLD 400 social ETF. So it's basically a fund. And if you see right now, again, during the pandemic, we saw a decline happening here. And very soon, we again saw the increase right here, right? So from $80, it went all the way to $140 from the pandemic. In last 1 year till now, it has gone to $140. Then there is a stock split, I think, which has happened. And you can see now the split has happened in the price. But from $80 all the way to $140, again, more than 50% increase. So this is something which is a trend now. Most of the youth and investors, they are focusing on clean energy and ESG investing. This can achieve alpha because the returns which I told you is better than NASDAQ in 1 year. And NASDAQ is a tech sector. So ESG has actually outperformed the tech, which you would never see. I mean, this had to be a parallel world to do that. So this has happened. What I would suggest you is make this as a part of your portfolio. Don't exhaust all your savings into it, but this again should be a diversified part of your portfolio, which you should definitely have. And any financial consultant can construct this portfolio for you where you have sufficient exposure in those companies which are less sensitive to the market and are into clean investing also.
Thank you. Last question from our Vice Chairman, CA John. John, can you raise your question, please?
Yes, please.
Thank you, CA Ajay. I have a question. Suppose a person wants to invest in a US market.
Yes.
And later on, suppose he will be relocating to India later.
Yes.
So how is going to deal with these shares he already invested?
See, it's a very good, yeah, please go ahead.
Can he continue to invest from India from the same account from UAE, or can he use Indian account? What is the flexibility? Is it easy to do that? Can you advise on that?
Correct. So thank you so much for your question, Mr. John. This is a question which is asked by a lot of investors. If we wrap up to India, see the most easiest way. Again, it depends on broker to broker. There are some brokers like Interactive Brokers, for example, they can still allow you, because those brokers who are directly dealing with direct stocks, which give you the delivery of the international stocks. Those kind of companies may still allow you to use the banking from India, because if you are doing this stocks in the form of CFDs or derivatives or in margin, then the countries, a lot of countries may not allow you, like Pakistan, for example. The international brokers, there is very less chances of opening and funding through Pakistan when it comes to CFD trading, right? Similar way, there are some restrictions in Indian banking also, where if somebody is transferring dollars internationally to do a transaction in international stocks, there is always in margin trading related stocks or CFDs, there's a restriction. So if you are trading in derivatives, I'll give you both the answers. If you're trading in derivatives like CFDs, make sure that you have a non-resident account open in UAE, because it is a lot easier from UAE banking. If you're dealing with any broker who's located in UK, Cyprus, Australia, Singapore, anywhere, it is easier to do a UAE bank account. If you move on to India, always have portfolio with those brokers which are providing you direct access to which are giving you deliveries, not the replicas of the stock, because you get dividend in both of them. But one of them is a derivative market where you can take leverage, put X amount of funds and take more higher positions than you deposit. Second is on cash. The cash you provide, the cash you put, that many stocks you get. So that is something which you should look into. But please make sure that you do talk to your respective consultant in India, who will be able to tell you the tax implications on it. Because as of now, if you're trading through here, see, if you have your bank account, non-resident account here, and you are buying derivatives or direct stocks, there's no capital gain tax on it. But once you move to India and once your KYC gets updated and your banking is using, and if you're getting direct equities, then capital gain, long-term capital gain, short-term capital gain, that can be subjected. So that's why a lot of investors, what they're doing is they are keeping the non-resident account open in UAE and very easily doing the transactions. So there are a lot of banks who can provide you this facility.
Thank you. See, Ajay, any other questions? Can I propose vote of thanks?
Yes, please, go ahead.
Thank you, Ajay. Good evening, everyone. It's my honor and privilege to propose vote of thanks on behalf of the chapter for today's webinar on VAT updates and global investment opportunities 2021. Today's webinar was engaging and informative. I am sure that all members attended today have enhanced the knowledge on VAT and global investing. Thank you, Ms. John Clark, Gulf Tax Director at Pinsent Mason, for giving us insight on VAT. We thank you from bottom of our heart for taking time to interact with our members. I take this opportunity to thank Mr. Yogesh, Global Market Strategist at Century Financials. Thank you so much, Mr. Yogesh, for interesting talk, and thank you for being with us today. I thank all our committee members for their support. I would take this opportunity to thank all our sponsors. I wish to express my gratitude to all the participants attended today. I hope it was a great learning for all of us. Thank you for being with us this evening. It has been a great pleasure. Thank you, everyone. Thank you very much.
Thank you, sir. Thank you very much.
Thank you.
Thank you, ma'am.
Thank you so much.